There seems to be two major theories right now everywhere you look, whether it's YouTube or crypto Twitter or the mainstream media. The first theory is that the bottom is most likely already in, and it was priced into the markets because people looked ahead and saw things like inflation, layoffs, and just the overall damage done from the whole 19 crisis. Now, the second theory is that we are just starting to get into this bear market, and a lot of macro evidence points to the fact that, in fact, we have not priced things in and that there is a lot more pain ahead. In this video, I'm going to address these two scenarios and give you the opinions from some of the most respected and qualified investors in the world to deliver their opinions on what's going on. If you're new to the channel, guys, my name is Chasse. I've been in crypto for 12 years. On this channel, we go into deep dives about the best projects in the crypto space, and more importantly, during these challenging times that we have seen and have ahead, I'm going to be covering a lot of the macro news because the most intelligent investors will tell you that the most significant moves are made in a bear market, not in a bull market. So if we properly navigate the road ahead, there is a possibility here to make life-changing gains when we see the next bull run. If that sounds good to you guys, make sure you like the video, subscribe to the channel if you're not already, and let's get into it. So a lot of the things I'm going to talk about in this video come from the All In podcast. This is an excellent podcast. If you guys aren't paying attention, I suggest that you do watch it. On this podcast, there's 4 highly qualified experts in the field that I definitely would rather take their opinions than the mainstream media, or certainly over other crypto YouTubers that are giving you their opinion on the markets, especially, I mean, there's exceptions, of course, but most of these guys have been in crypto for less than a couple of years and really aren't even old enough to understand market cycles. If you haven't checked it out already, I suggest that you do. Again, that's the All In podcast. I will actually leave the link in the description below for you to check out as well. First of all, let's talk about the $30 trillion mistake that's been made. You've probably heard this before, but 80% of all the US dollars in circulation were printed within the last 2 years. So according to math, we have approximately 35 trillion US dollars too much in circulation right now, and that needs to somehow go away. As you can see by this graphic by Visual Capitalist, the United States GDP, meaning like all the value created from the goods and services in America, is about $25 trillion a year. And somehow we have $35 trillion of too much money in circulation. That's a really, really challenging task ahead to try to imagine how to take $35 trillion out of circulation when the US as a country only produces $25 trillion of value every year. This is just a very challenging task, and Chamath thinks it'll take at least 18 months to not come anywhere close to getting rid of this 35 trillion in excess, but getting to a more sustainable place to where we could see, the bear market coming to an end. So how did the US allow this to happen? Well, it all started back in 2008 during that financial meltdown when there was a new idea called modern monetary theory. Now, modern monetary theory was created as an instrument or tool to essentially alleviate the 2008 financial crisis. It was intended to be implemented in the interim just for a year or two in order for businesses to be able to grow and thrive and get the economy back on track. However, the problem is that no one ever turned off the money printer, and it has literally been running for the past 15 years. So according to Chamath, we really need to get this $35 trillion of excess money out of circulation to prevent things like hyperinflation, which would be catastrophic, or a severe Great Depression. So in order to get this money out of circulation, the Fed needs to do things like sell back bonds to collect more cash and remove it from circulation, and also selling things like securities, which could be different stocks and other assets like real estate that they might have on their balance sheet. Now, of course, this will lead to sell pressure in the markets, which would lead to downward pressure. And I do not think that we have a lot of people who are buying stocks right now. In fact, a lot of people are fleeing into cash. So as you can see, this needs to be done in an incredibly calculated way in order to, if it's done too fast, it will surely cause a huge crash, like big crash, like 2008 at best, but Great Depression at worst. In 2007 and 8, when we had this collapse, it needed to happen because at that time, everything was overinflated and overpriced and people were being irresponsible. When you run a business in an irresponsible way, you don't deserve to continue operating. However, the banks had so much power that we decided to bail them out and do modern monetary theory instead, which didn't allow things to collapse. In fact, it just kicked the can down the road to where we are now. Now, very smart and intelligent economists have been saying that a collapse needs to happen, things need to correct and basically reset. So the question that I ask myself often when I'm looking at the crypto charts is this a good time to enter? Or do I think that the money printer might be turned back on? They might lower interest rates again in order to continue to kick the can down the road? Or are they actually at a place right now where they don't have an option because printing more money would just lead to more inflation, which would really, really hurt the people at the end of the day? They're already seeing higher gas prices and groceries. So while I don't anticipate a major move up in any of the markets anytime soon, I do think that there will be periods of time when it feels like things are getting better. Because again, we're looking at, in my opinion, and the All In podcast, it seems like the overall consensus, and people like Michael Saylor and guys like Ray Dalio and Robert Kiyosaki, like all of these brilliant minds seem to be in the same state of consensus that we have not seen the worst of it yet. My approach on this is really, if we do get these temporary pumps, I'm going to take profits on some of the things that I have, and I'm going to try to accumulate as much stable coin as possible in case we do get severe correction from here. I have even more dry powder sitting on the sideline ready to put into the markets. So when things started to get really out of control, there were plenty of prominent figures who spoke up about this and voiced their opinions. However, the Fed chose to ignore it. For example, let's talk about one of the other guests on the podcast, David Sachs. David Sachs is a serial entrepreneur, very successful investor, and one of the co-founders of PayPal. So David says he can remember a time when Drunken Miller made a quote: "I can't find any period in history where monetary and fiscal policy were this out of step with the economic circumstances." Drunken Miller just said basically that the central bank had kept its foot on the accelerator for way too long. So during the pandemic, quantitative easing was introduced. Now, what does that mean? That essentially means that the Fed was directly buying assets on the open market. That means mortgage-backed securities, stocks, bonds, things like that. What that does is it creates buy pressure, increases the prices of these assets, but also introduces liquidity back into the market, right? They're literally exchanging cash for assets. Now, what does quantitative tightening mean, and what we're looking at in the road ahead? And how do we pull money out of the economy? Cash? Well, the opposite needs to happen. That means they need to start selling the assets they acquired back then in order to recoup the cash that they got and put the assets back in the open market. This is going to create a lot of sell pressure, but it's necessary to remove the circulating cash. Drunken Miller also said, if we're going to monetize our debt and we're going to enable more and more of the spending, that's why I'm worried now for the first time within 15 years, we lose reserve currency status and of course, all the unbelievable benefits that have accrued with it. Right now, the US dollar is considered the world reserve currency. It's actually required for a lot of countries to keep a certain amount of US dollars in their reserve in order to even do things like trade oil with us, for example. However, if that reserve currency starts to inflate so much that purchasing power drops so much, it doesn't make any sense to hold that as a reserve, because no longer does it become a stable reserve, it becomes a very depreciating asset. And what would happen in a case where you start to see hyperinflation from the US dollar? It would make the most sense for anybody who holds those dollars in reserve to sell them immediately for a more stable asset like gold or whatever. In this case, the Chinese RMB or whatever. We all hope that's Bitcoin, right? But the point is that if the Fed continues its irresponsible patterns, the dollar will inflate so much that we will see major sell-offs around the world, creating even more supply with way less demand, making the dollar worth significantly less, according to any other type of asset around the world. If the United States loses its world reserve currency status, it will be a dramatic shift in the entire world for the way that trade is done, the respect the United States has, and literally will be devastating to all United States citizens. Even some of those famous investors in the world, like Ray Dalio, have come out and publicly agreed with this overall idea that the Fed has been irresponsible and is now pumping the brakes, which can cause a tremendous amount of problems. So now let's get into a little bit about why we believe that we potentially are just at the beginning of a very rocky road ahead. So David Sachs from the podcast goes into talking about these kind of issues. The fact that the word recession keeps coming up and up over and over again on financial channels, on the mainstream media, this is now starting to become imprinted in the average consumer's brain, which means what are they going to do? If they're responsible, that means they're going to stop spending and try to conserve as much as they can because they know that their survival is at stake. What does it mean when they stop spending? That means that businesses stop earning revenue. That means that businesses need to start reducing their burn rate. How do you do that? Well, you lay off employees, which leads to more unemployment. More unemployment leads to government literally spending more money on giving them unemployment salaries. And that means that's even more difficult then for us to take money out of the circulation. And so the whole thing becomes a death spiral where it becomes a very, very, very hard hole to get yourself out of. This also means that because interest rates are rising, much less people are going to do things like take out loans because they're more expensive. It also means that people won't be looking to start new businesses right now because there's probably less of a customer base to serve them. That means that big real estate firms will not be buying commercial real estate because there's not going to be businesses to rent out their office space. Or that means that the businesses that rent out retail space like restaurants and things like that will not be able to, one, pay their rent anymore because they don't have enough business, or two, just not be renting new space in empty buildings. So clearly the warning signs have been here for a long time, and you can't just blame this current administration or the past administration or the one before that. This is the Fed, the Federal Reserve, the guys who print the money and lend it to the government. Now, this is an incredible topic in its own right. And guys, if you want me to make a video on how the Fed and central banks work and how it's an entire monetary system based on debt that is essentially the root cause of a lot of the problems that we have today, let me know if you want me to make that video in the comments below. So who's to blame for this? Well, guys, I mean, we certainly can't blame Joe Biden. I mean, like as much as I would like to, the guy doesn't even know how to get off stage or read from a teleprompter or a million other things that he's done. So it's actually the Federal Reserve who is responsible for controlling the supply of money and the inflation rate. The United States' goal is to maintain on average a 2% inflation rate per year. However, as we've just seen, the most recent reports, official reports coming from the government themselves, says that we are at a 9.1 inflation rate, which is the highest it's been since 1981. I would say that 9.1% is incredibly optimistic, and it's more likely much, much higher than that. Now, ShadowStats is essentially a website that covers what they call a hidden tax, which is the same thing as inflation. It's just sold to us in a different way. So have you noticed that a bag of chips has less chips in it, or that a Snickers bar is much smaller than it used to be? This is an example of shadow inflation or a shadow tax. Back in September of last year, it was reported by the government that we were at 5.4% inflation rate at that time. However, ShadowStats said that based on the formula that they use is something more like 13.4%, which is over 2x what was reported. So if the same logic is applied, we can assume that the actual inflation rate right now is more like somewhere between 18 to 22%. Unless you are making 20% more on your salary than you were last year, you're losing purchasing power. So while things like US dollars might be one of the best places to hold your net worth right now, you also have to understand that if you're putting your US dollars into a savings account at a bank, well, I just looked it up. The average savings rate for national banks in the United States is 0.1%. But let's be optimistic and say that it was 0.5% interest on your savings. That would mean that your money is losing approximately 19-20% a year purchasing power by just holding it in a bank. That puts another perspective on things like what are we supposed to do here? Where do we put the assets that we do have now? And I will get to that in the conclusion of this video. So now let's kind of get to some of the takeaways from the podcast and the potential opportunities that might lie ahead. So Chamath believes that there's not really any roads looking forward that lead to better days anytime soon. In fact, he thinks that inflation will continue to increase, that prices will continue to increase, and this will be very, very detrimental to equities. And he thinks that things like the housing market can see a 30% correction very, very soon, a decrease in equities, stocks, means that we will see a correction in crypto. This is why I am personally making an effort to sell some of my assets when we see pumps in preparation for a potential much, much lower market. I'm definitely not selling all of my crypto and going all into fiat. What I've been doing is looking at the ones that to me don't feel like they're going to survive through a bear market, or overall ones that just seem like there's too much competition in the space where when times get really, really difficult, usually only the biggest players will survive. So I have been pretty heavily coming out of these positions into stablecoins. And I think one of the best things that you can do if capitulation happens is to enter back into the best blue chip projects in the space that have the best fundamentals looking forward to take advantage of that. Because at a 70 to 90% correction from all-time highs, that means that there's an easy, almost guaranteed 5x in these things when the market does return to bullish sentiment. 5 to 10x is only returning to all-time highs. Traditionally, in every single bull market, we have surpassed old all-time highs, which leads for a lot bigger potential gains. And in my opinion, is a very, very low risk with high potential reward opportunity. In fact, one that we have never seen before. Because in the last bear market, we didn't have too many projects other than Bitcoin really, and Ethereum to some extent, to really show traction and adoption and real user bases and real other developers using their services, things like that, which we have now seen. Things like BNB and Chainlink and Matic, Polkadot. Essentially, these things all have traction. They all have huge communities, and they're all 70 to 90% below their all-time highs. Okay, now let's talk about some steps that you can take to maximize this opportunity, because what we talked about is troubling. However, it can be the best time to enter the market. If you have a job right now and you're basically making what you need to survive, get a side hustle, because your job is probably 40 hours a week, which means you have another 20 to 40 hours a week to work to earn extra capital, even if it's just quite minimal. Even over the course of the next 6 months, if you only earn $10,000 and you put that into the market, into good blue chip cryptocurrencies, likely that $10,000 turns into $100,000 in the next bull run. That is massive. You just 10x your money. Another thing that you can look at is selling all the crap that you don't need. Stop spending money on ridiculous stuff and sell things that you don't need, that like aren't absolutely necessary right now. If you really want to take your financial freedom seriously, sell all the shit you don't need. Just sell it. Just eBay, yard sale, whatever, because potentially every dollar you earn today can be 5, 10, 20, 30x in the next 2 or 3 years. So now let's talk about if you run a business or you're an entrepreneur, you must look at your runway. At your current burn rate, how many months can you survive? How many years? David Sachs from the podcast recommends that you have at least 3 to 4 years of runway in order to survive through this bear market. It used to be the industry standard that you would need at least 2 years of burn rate, but now you need to extend that, because like we've said before, this could be the beginning of really troubling times. You can also see on this chart that he has, it's just survival of the quickest, meaning who's acting quicker. And the company A, the red line, you see this company that did not reduce their burn rate during troubling times. The green line is company B, who saw troubling times and cut their burn rate immediately in order to extend it and then grow slowly over time. I have been through bear markets before, and it cost me dearly because I didn't know this lesson. So make sure that you listen to things like this and take people's advice seriously. This time around, starting in early May, Master Ventures cut its burn rate by 55% and is also looking for other ways to increase cash income to even extend our burn rate further. In the crypto space, a bear market is good for several reasons. Of course, there's pros and cons, but one of them is you get to see which crypto projects survive the bear market. And this is a true test of business intelligence, proper planning, and just pure endurance, passion, and everything. I love to see who gets flushed out in a bear market and who doesn't, because more than likely, those who survive end up doing phenomenally well in the next bull run. So another guy who's been very public about his opinion of way more pain in the markets is Kevin O'Leary, from Shark Tank. And he says, I like a big panic event. That's always been a great way to bottom. It's towel throwing, it's capitulation, it's massive volume, it's total panic in the streets, and always a great buying opportunity. He's right. Like, we haven't seen major capitulation yet, and usually always bottoms come with major capitulation. That means, like he exactly said, major volume, major panic, major fear. Everyone's just running around, bumping at each other, like not knowing what to do. And it's too late at that point. If you're still in and you haven't sold out at the point, and you don't have the dry powder sitting on the side. So let me just wrap this up for you in something that you can take away. So we know that we're in a very, very bad position economically right now. We know that inflation is incredibly high and it potentially is going to go higher. We know that we have uncertainty around the world with the Ukraine and Russia war. We also have heard from several different, very intelligent investors, entrepreneurs, and advisors who all have the same general consensus that we have much more pain to come in the markets. So what do you do from here? This is really up for you to decide. I can only give you what I have learned, and you do your own research on what makes the most sense for you. For me, I will be, as I said, selling into pumps that come, because during bear markets, we still have pumps, and I will be dollar cost averaging into the best crypto assets all the same time, trying to figure out more ways in order to take advantage of the rock bottom prices on some of the best crypto assets in the world. And most importantly, for everybody watching this, make sure that you can take care of yourself no matter how bad the markets get. That means if you're overexposed in the crypto markets or in stocks or in real estate, it doesn't matter. Imagine that all gets reduced by an additional 50%. 60% from here. Can you sustain and survive? If the answer is no, you urgently need to change that to where you feel comfortable, even if the markets collapse another 50, 60, 70% from here, because it is definitely possible. Guys, thanks so much for watching. I feel this is an incredibly important video. Let me know in the comments below if you have any thoughts on what's going on, if you thought I was wrong about anything or anything I missed. And I will catch you guys on the next video. Bye-bye.